I was going over your lecture from our first meeting. I understand equity is like your claim on an asset. So when you hear the term common equity, does that mean like when you're talking about like stocks, does that mean all the shareholders, the common equity shared by all those shareholders? Is that correct?
Well, common equity is also a term used for common stocks.
Oh, okay. Oh, okay.
But you don't, yeah, people normally even say that common part of it. So equity automatically refers to common stock. Why? Because preferred stocks, although they also are kind of equity, but they are not part of the organizations or the companies raising money. So basically, they are not publicly traded. So when you say that I'm the stockholder of a company, the assumption is that you're a common stockholder, not preferred stockholder. Make sense?
Yeah.
So common equity is the same as equity.
No, I understand.
Anything else? All right, so I'm hoping that you all have your books and you all have your financial calculators, right? Outstanding. Okay. We're going to talk about present value and future value of money. So in order to open the discussion up, I'm going to ask a couple of questions. Obviously, we know that money has higher present value than the future value. Why is that? Why we consider value of money higher at present versus future?
Is the interest it could earn and compound between now and some future date?
Because money has opportunity cost. What is opportunity cost? Opportunity that you forego to give your money to somebody else to use it. Therefore, for that you have to pay what? Interest rate. So if you have money, let's say I have $1,000 and I lend it to, I don't know, Steve. And Steve said, okay, I'm going to bring you money back next year this time. I'll pay you back. Okay, great. But when he pays me back this 1,000, I'm going to demand more than that. Why? He's going to ask me why you want more. I'm going to say this is the interest rate. He's going to ask me what is interest rate. I'm going to say, well, you remember, I forgone the opportunity to use this money last year. What is the opportunity cost? Well, I could have either spent this money or saved this money. If I would have saved this money, I would have gained interest on it. If I would have spent it, I would have gotten fulfillment out of this money, but I have forgone that. So, therefore, since money has interest rates, and interest rates meaning that as your money is invested in anything in life, it's going to gain what? More value. Follow me? Therefore, your future earning could also be a reverse process. What I mean by reverse process is that if somebody says, in the example of the 1,000 between Steve and I, if somebody says, hey, $1,000 that you're going to give to Steve after 1 year, what is the value of today? You follow me? Meaning that I gave him blood, let's say $1,005 or $1,010. I'm going to start again one more time, make sure that you get it, because it's very important between Steve and I. If he borrows from, or I borrow money from him, $1,000 today, after 1 year when I want to pay him back, I have to pay him what? More than 1,000. We got that part, right? It's very simple. What our lives is all about that. However, now my question is, that value of that 1,000 from 1 year from now, how much is it today? Okay? So in order to understand that, in order to calculate, they're going to say, okay, what kind of interest this money would have gained if it was invested? Let's say in our example, we said $1,010 that he gave me at the end of the year, right? That's 1%, right? So 1% is difference between now and the future. But now I'm saying that what is the future 1,000 worth today, then you have to discount it with 1%. You follow? Meaning that instead of compounding it, you have to discount it. Okay. That's the concept, but I'm going to work on it. I'm going to give you examples. You're going to have a very solid idea about it. Now, in order to understand this better, imagine that we're a bunch of investors, okay? And then we would like to buy something, let's say, building across the street, a large, big building, I suppose. And there is a price on this building. And then we were wondering if this price is a right price for it, or if this is a good investment or not. In order to calculate that, we have to calculate the present value of our what? Future income. So what is the process in evaluating whether we want to, or any investment? Now in this example, we want to buy this building or not. What are the process? There are 4-step process that is applicable to any investment. So we're going to take a look at those. All right, but I'm going to need your help though. I'm going to say, hey, we're a group of the investors. We have the ability to raise the capital as much as we want. Okay? We could issue bond, we could issue stock, we could borrow money from bank. So sky's the limit how much we could raise. A bunch of investors could do that. And I'm saying that, look, that building is like 20-story building and is office building, meaning that they rent the offices in there. And the price on it is listed as $100 million. Meaning the individual wants to sell that for $100 million. And I say, folks, should we buy this building? Is it a good investment or not? So what do you think the steps that we're going to be taking here? And put yourself in a realistic position, as if we are that. And I'm asking you, shall we buy this building $100 million? What's your answer?
What return do you expect?
Charles?
Yeah. What return would you expect?
Okay, well, what Charles is saying, what kind of cash flow or return expected from this investment? So that's our first step to calculate that, huh? All right, so what is the generation of the cash flow from this particular building? All right, we said like 20-story building, let's suppose. And a story, let's say story has like maybe 10 units. So we're talking about 200 units. What's the monthly rent on it? Let's say 5,000. So it'll be what? 100,000, right? No, that'd be 3, 4, 5, 3, 4, 5. Okay, 1 million. Now then, we're going to get $1 million a month from this building. Okay, if it's 20 or 200 units, and let's suppose if 200 units is 10,000, that'd be 2 million, but it's 5,000, so 1 million. And let's suppose that therefore annual cash flow from this is $12 million a year. Okay? So far so good? So, but however, we know that within 20 years, after 20 years, I should say, we're not going to be keeping this building because we have to demolish it. It's an old building. The life of it is only 20 years. Okay? Just assume that. So I'm saying, okay, the first year, we're going to get 12 million. Second year, we're going to get 12 million. Up to 20 years, we're going to get 12 million every year. That's our projection. Now, if we're going to do some of the examples in the future, there's some other calculation involved in it, like how about expenses, right? Obviously. So let's suppose this is our free cash flow. Meaning that, yeah, we're collecting more than 1 million, but we have some expenses that when we deduct our net cash flow or free cash flow is 12 million. Let's assume that for now. Okay. We did that, Charles. What's next?
What's the interest rate?
Good. Now, before we get to that, if you look at this, you're going to say, hey, look, for 20 years we get $12 million. So within 10 years, we're going to have 120 million paying off our original investment. So why in the world this is not a bad investment? This looks great, right? But not necessarily so. What Charles said that what is our interest rate? Basically what it's referring to is that what's our cost of capital. What is cost of capital? Anybody? What's cost of capital?
It's like
Okay.
the return that you could be getting elsewhere, so like the opportunity cost.
We talked about that, but yeah, that's true. That's true, that's what it is. However, at this point, what is our opportunity cost or capital cost? Our capital, folks, what are we going to get that 100 million? Where are we going to get it from? Think about it. Oh, we're going to issue stocks. Okay, what's the expected rate of return on your stocks? Oh, 12%. So 12% is cost of your capital. Oh, we're going to borrow from bank. Okay, what's the interest rate on the bank? 8%. So our cost of capital is 8%. Why this is important? Because if it's we'll be paying 8% to hold this $100 million, we're not going to invest in anything that is going to give us what? Under 8%. Simple as that. In order to know whether what type of investments are attractive investments, what types of investments are not, you have to determine cost of your capital. That's the first step. So, in reality, what happens here is that the source of your capital are more than just one source. Meaning what? Meaning that normally firms issue short-term notes, meaning that they borrow money, or they issue debt. What is issuing debt? What does that mean? Issuing long-term debt.
Bonds?
Bonds, exactly. So either we could borrow money from bank or bond, or what? Issue equity, which is stocks. So normally companies do all of them in combination. And we're going to talk about it in the future. You're going to say, what's the method to do that? That gives us the lowest cost of capital. Because with the mixture of these, combination of these, you could bring the cost of capital low, to lower level, without being more risky. So what I'm referring here, folks, is basically somebody may say, hey, look, if you issue bond, it's going to be, the payment on is going to be 10%, meaning that you're obligated to pay 10% on your bond for the bondholder. If you issue stock, it's going to be 12% expected rate of return or cost of equity for you. But if you borrow money from bank, 8%, seems to be better than anything else, meaning the banks are going to give you 8% while you're issuing the bond, while you're issuing stocks. Answer to that is that if you are financing your investment 100% based on debt, now debt could be both bond and borrowed money, but let's suppose for the sake of conversation we say borrow money. You're extremely, risky. And what's the consequence of it? Okay, I'm risky, who cares? Well, banks care. They told you 8% when you borrow only 20% of your capital needs. But if you need 100% of it, it's not 8%, it's 18%. So you see, it becomes more expensive than bond or stocks. Banks are not idiots. Banks are not sitting there and say, oh yeah, well, whatever, have 8%. And if you're like 100% levered company, levered means leveraged company, leverage means debt. So, well, we're okay. No, they are not okay with that. Higher your level of debt is, higher level of your risk is, therefore higher interest you're going to pay. Not only interest for the bank, but also rate of return on your stockholders, because you're a risky company. Therefore, here, all the financial managers try to combine these three sources to make him to be lowest possible, but also what? Lowest risk. So we said that, lowest possible we know is a bank. If you borrow money, say 8%, it's lower than all of them. Yeah, that's low cost of capital, but it's high risk. You don't want to do that. Now, but if just because you're high risk, you're not going to even be able to get 8%. Therefore, you have to combine these in certain manner by which your cost of capital is lowest possible and your risk is also low. Now, is there any method to that? You could imagine, yes, of course. And we're going to talk about it in the future. Now, coming back to our decision, investment decision here. So, what is cost of our capital? Let's say we issue bond, we borrow money, we issued common stocks and so forth, so on, and our cost of capital end up to be 10%. Okay? Meaning that combining all our different sources of raising money, the way that I mentioned, bonds, stocks, and borrowed money. Each one has a different rate, right? Also, each one has a different weight, meaning that, hey, 20% I borrowed, 40% I issued bonds, 40% I issued stocks. You see what I'm getting at? The weight. So when you multiply the weight by the cost of it and add them all together, it gives you the what? Total cost of capital. We're going to talk about it in the future. That's why I'm not writing on the board yet. But just giving you the idea that how 10% is attainable. Also, some companies will say, hey, I'm going to go 100% equity and issue stocks and my expected rate of return on my stock is 10%. Okay, no, that's fine, that's your choice. However, 10% here is our next step. But what's the first step? Determining the cash flow generation of this investment. We did that. What's our cost of capital? We did that. What's the third step? And third step is the subject of what? Tonight's discussion. What is it? What do we need to do now?
Figure out present value. Figure out present value.
And what is that, Charles? Absolutely right. But what is that? What are we going to do here?
Identify cash flow or expected cash flow and then discount it.
We already find out the cash flow. So we're gonna discount everything from 20 years, 19 years, 18 years, and all these years with 10% to present. What is discounting? Let me give you an idea what discounting is. Let's suppose this is not the scenario. We got 100 million. We just have 100 million. And we're gonna say, hey, if I invest this 100 million in an account that pays me 10% compounding interest rate, you follow me so far? For 20 years, how much money I'm gonna have here? We could calculate that, by the way. Well, let's suppose we say, 100 million, that'd be like a 10% growth. Let's say that'd be like 500 million. That is not the answer, but I'm just making this number up to give you the idea. We could calculate it in just a second. Well, I'm gonna have 500 million after 20 years with 10% interest. Yes. Now, if somebody asks you this question, hey, tell me, what is the present value of this 500 million 20 years from now with 10% interest? What's your answer? You know the answer. What is it? What is the value of $500 million 20 years from now with 10% interest?
100 million.
100 million. What did you do here to come up with 100 million? You discounted this 500 million with 10% and brought it to the present. Exactly a reverse process when you are making what? Compounding value to find this future value of this, meaning that you compounded it with 10% every year till you get what? Future value of this, which is, let's say, we made up number like 500 million. So what are you gonna do? Find out the present value of your future income. Opposite. You follow? So your discount rate is like a coin. One side of it says discount rate, the other side of it says what? Compounding rate. Compounding rate basically is interest rate that is compounded. So one side of the coin is interest rate or compounding rate, the other side of it says what? Discounting. You're using the same coin or same percentage, but when you want to find out the future value of your present money, you use what? Compounding rate, meaning that you call it compounding rate. It's the same rate, but when you want to discount or find out the present value of your future income, that in that case when you use that rate is called what? Discount rate. Everybody's with me so far? Any questions on these? These are very important topics because these are the fundamentals of what we're going to build upon in our future discussions. So we have to have solid understanding of what future value, what present value mean. So, and this is basically common sense. Somebody says that, hey, instead of $500 that I could give you today, I'm going to give this money to you 20 years from now. Just think about it. Oh, wow, okay, well, obviously I'm not going to accept this proposition. I want it now, not 20 years from now. Why do you say that? Because the future value of this 500 20 years from now is not 500 anymore. And maybe it's $100. Why? Because money has time value. You follow? Okay. So let's suppose we discounted all our future cash flow to $1 million a year with every year and we brought it back to present. What's the next step? You're going to add them all up. Let's say present value of 12 million 20 years from now. How much is it? Let's say I'm just making up 3 million. Okay. What's the value of for 19 years? Whatever the number is. And you're going to do for all of them and add them all up. At the end, you're gonna have a value. Let's suppose that is $250 million. That's $100 million, $150 million. Let's suppose you add them all up, it became that. I'm just making these numbers for now, making up. Okay, what's the next step? Actually, it's part of the fourth step, but what do we need to know now? Okay, our investment has value of $150 million. Is it a good investment? Yeah? How much did we invest? How much we got? Oh, it is good investment. So this is called net present value. It's not called net present value, it's called the present value. But if you deduct 100 million from it, you're gonna have positive 50 million, right? That is called net present value. If your net present value in any investment is positive, that's good investment. If it's negative, it's not. Simple as that. That's how you determine viability of your investment and how you take those 4 steps to evaluate the investment. Charles?
Well, this was with the assumption that we just already had $100 million, right?
No, remember, I said that we are the group of the investors. We have the ability to raise money from any sources, and it's unlimited how much we could raise. You see? So here, obviously, of course, for some people, that cost of capital is not the same as other people. Meaning that the avenues by which you raise capital and how much it's going to cost you is different from company to company. As a matter of fact, one of the main reasons is that in some industries, in all the industries, there are expected rate of return on equity. Meaning what? Meaning that if you're a computer industry, when somebody buys your stocks, the expected rate of return of the computer industry, it averages 12.5%. So if you buy a stock of any company in computer industry, let's suppose, you're expecting that stock yields you over 12.5. Therefore, if you're the issuer of that stock, you're obligated to what? Pay him 12.5% to keep him happy, minimum. So that's called cost of equity. So when I have the stock issued, rate of return of it to you it'll be to you as a stockholder, you call it rate of return. To me, that's cost of equity. I'm paying that. You follow? Therefore, each industry has its own what? Average rate of return. That rate of return in transportation, LTL markets transportation is 3.5%. So it depends who you are and what are the expected cost of capital or expected rate of return on your issue or on your financial assets or whether that's stock, bonds, whatever. What is the expected rate of return on your debt or common stock? So for instance, in bond is the same. Some bonds, we're going to talk about this. So some bonds basically give you higher payments. Rate of return in bond is different than payments. I hope we're going to talk about it to understand. In other words, what I'm getting at is that when people issue bonds and you're the bond holder, there are 2 interest rates associated with it. One is the interest that is based on that you're getting your what? Payment or interest payment every month or every year. Follow? Hey, I issued a bond, $1,000, and I'm saying that this has a 10% coupon rate. Therefore, I have to pay you $100 a year till the maturity date. Let's suppose it's for 10 years. For up to 10 years, you're going to collect what? $100 a month, or a year, I'm sorry. Okay, that's your interest coupon rate of your bond. However, what is my total rate of return in bond? It's not that anymore. Your total rate of return in bond is called yield to maturity. We're going to talk about all those. So my point of saying all these is that in bond, you have to take a look at, what's the payment on it, and what's the yield to maturity of it, meaning that what is the total rate of return of this bond. And for different bonds, it's different rates. Why? Because if you're buying the bonds of IBM, definitely is more what? Trustable, has a low risk than you buying, let's say, bond of a new casino in, I don't know, Indian reservation. Or somebody who wants to embark in a very major project, but nothing is certain about it, and issues bonds to get money. So meaning that level of the risk of each one is different. When the risk is different, then what? The value of the rate of return of it is going to be different. You follow? So anyways, my point is to tell you that cost of capital in each industry is different, for each company is different. I think that's the question you asked. For each different company is different, for each industry is different, depending on who you are, what industry you belong to, and what are the expected rate of return on your stocks or bonds or whatever. Okay, now, this was a kind of introduction to tell you folks that in finance, all the financial analysis in all the criteria by which you do valuation of the investments are based on what? Present value of your future income. That's something that is not very common for all the people to say, yeah, well, I have to. People don't calculate no more, don't think about it in that way. That, hey, $1 million 10 years from now is not 1 million. Is way less than that, depending on the what? Discount rate. Obviously, higher the discount rate, less the value of it is. You follow me? Okay. Now, what we're going to do, there's some introductory stuff in this particular slides, which is straight from your textbook. And I'm going to show you the formula for it. And also I'm going to be asking you to use your calculator to calculate future value, and then later on present value of certain examples. So, first, we're going to talk about future value. So future value of any money is the present value of it multiplied by 1 plus I power of n. So what I'm talking about here is, folks, the future value of your money always equals the present value of it multiplied by the interest rate that's associated with it, power of the number of the years. Okay? Now let's take an example. I'm saying that I have $100. That's the present value of my money. And I'm going to put in an account that gives me 10%. Okay. I'm going to be investing this in first year. Only 1 year. How much I'm going to have at the end of that first year?
Oh, 110?
Yeah,
Oh, it's-
I'm just going to grab this and do it for a number of the other years as well, so might as well take it out. So $100 times 1.10 is 110. Okay? So my $100 earned $10. So far so good? Okay, so that's future value on what? First year. Future value of year 2 is 100 times what? 1 plus 0.10, 10% power of 2. So let's see how much that is. Okay, that is 1.21, right? Which is what, $121. That's future value for year 3. How about 4th year? 100 times 1 plus 10 power of 3. What is that? 1.33, $133. Okay? Simple as that. Meaning that I'm saying, hey, if I invest my money in an account that gives me 10%, how much I'm going to have in first year? What, $110? How much I'm going to have in second year? $121. How about on the year 3? $133. So you can see that is the process is a compounding process. What do I mean by compounding?
So instead of simple interest, there's compounding interest. There's two different.
If I would have gotten simple interest, what would have been my rate of return on this?
Oh, after 4 years, that would have been just.
Well, let's just for
Oh.
each year. Well, first year would have been 110. Second year would have been 120. Third year 130. Fourth year 140. You see what I'm getting at? But we don't calculate it like that. Why we don't calculate it like that? Why all the real interest rates are compounding rate? What's the difference? What happens here that the interest is or the money is gaining more value? What happens here versus the simple interest?
It grows much faster with compounding.
I understand, but why?
Oh,
Because even the present value is added to it.
Meaning that your interest that you gain in every year also gains what? Interest on it. Make sense? That's why it's become exponential. Oh, I don't know if it's exponential, but it becomes, it has a higher rate than just simple rate. Okay? So, now, this is what I talked about earlier. Let me see if you're with me. Now, how about if I tell you, let's do this opposite. Meaning that I want to find out the present value of my future income. So, in other words, I'm saying that, okay, present value of my future income. If I want to find out what it is, this time I'm going to divide this with 1.1i of interest rate in power of whatever number of years. You follow? It's exactly opposite. Meaning that reverse relationship. So present value of $100 in with 10% in first year is how much? Can somebody calculate it and let me know? Also do that for second year. Do that for third year. Gayatri?
First year it's 90.91.
0.9.
1.
The first one?
Yeah.
Okay. Second one? Oh, I thought you were fast.
82.64.
83.64.
82.
82. 60. Well, let's say 60. Third one?
$75.13.
Okay. Now you see how did it happen here? Your money future present value of $100 1 year from now if you're receiving $100 1 year from now, the present value of that $100 in future, which is 1 year from now, is only $91 today. You follow? So it's not. So if this money is given to you 2 years from now, again we're using 10%. That money that you're going to be receiving, $100, 2 years from now, the present value of it is only $826. I'm sorry, $82. $91, $82. $100 you're going to be receiving 3 years from now has the present value of only $75 with the same rate. You see how it works? So, can anybody tell me what is the present value of $133 3 years from now with 10% interest? You're not going to use calculator. It's simple. $100. What is the present value of $133 3 years from now today with 10%? Well, $100. That's what we started with, right? So that's my point. Okay? Or I could just play around with it. What's the future value of $75 3 years from now with 10% interest? $100. You with me on these? Okay. Now, this is the foundation for many of our calculations that we're going to do in our investment decisions, in bonds, in stocks, in buying businesses, financing projects, coming up with the net present value of different type of investments. We're going to be all doing them all in this classroom. So the basic principle comes from this concept. We have to know that whatever future cash flow we're going to have, we have to discount it back to present to understand the value of that investment. Oh, is that applicable for stocks also? Yep. Applicable to bonds also? Yep. Applicable to everything in life, folks. Let me give the example. How do you come up with the intrinsic value or the true value of a stock? Well, the way that you do it, you basically calculate what you're going to be getting as dividend, also what you're going to be getting as capital gain on that stocks in the future, let's say for 5 years, and then discounting it all back to present with what? With rate of return of that stocks. It's the same process. Anyways, when we get to it, you're going to see how we use this. So, any questions so far? I just gave you kind of an introduction to this stuff, and then we're going to be talking about a little bit more, and also, like I said, you're going to use the calculator or Excel to do some calculation. Yes, Josh?
Is there a mistake on the board? I see that you wrote FV for the 4th year, but I see that you rose it to the power of 3. Is that? Was that? I'm just wondering if that was a mistake.
Oh, yeah.
Yeah.
Never mind.
Because the very beginning shouldn't be 0, so that's
should be not. No.
the not.
This
Yeah.
this was supposed to be 1, not 2.
Oh yeah. Oh, okay.
Okay. This basically was 1, 2, 3. Oh, 1, 2, 3. Yeah. Don't worry about that. We're gonna see some examples. See, that's gonna be. Who's gonna be my light man or light? Thank you. Okay. One of the ways that you best understand the calculation of the present value or future value to draw timelines every time that you want to do any calculation. The way that I did it on the board for our investment, I said for 1 year, 2nd year, 3rd year, what are the cash flows you're going to be receiving. So there are terminologies that I would like you to remember in the future. We have cash outflows and cash inflows. Cash outflow always is depicted by CF0. Anytime you see CF0, that's your cash outflow. However, CF by any other number, like 1, 2, 3, or whatnot, is called cash inflow. What those that implies? What is CF0? Why we say cash outflow and then CF1 becomes cash inflow? Why? And we're talking about the timeline, investment, all the good stuff that I talked about. Charles?
Is that the date of purchase?
Folks, remember that building? What did we do at the beginning? We paid $100 million. That's your cash outflow. That's your CF0. Then what? First year, how much you got? Oh, 12 million. That's a CF1. Next year, we got another CF, whatever, CF2. Follow? Okay. $100 lump sum due in 2 years. You could show it in that way. Hey, this I'm going to get $100 after 2 years. If you want to put it on timeline, you visually you see how it is. That's how you do it. And then 1% means that is the rate of it. 3 years, $100 ordinary annuity. It's shown like this. First year 100, 2 years, second year 100, third year 100, and that's the percentage. Now, please, going forward, if there is any word that you even have the doubt that what is the true meaning of it, don't let me just continue on. Stop me. Then, wait a second. What's ordinary annuity? What does that mean? You see what I'm getting at? Because that's not that I'm not going to explain it to you or define it to you. Is that sometimes I automatically may forget that, oh yeah, we know what ordinary is. No, not necessarily so. So please do that, okay? So first thing, ordinary annuity. What is annuity?
So I vaguely remember it. It's the annu part. It means like year, like in Latin. So it means payment is due at the end of the year. Is that, or at the beginning of the year?
Yeah, well that's ordinary annuity versus annuity due. But what is the meaning of annuity?
Pays out every year.
Pays out every year? In what? Same amount. Make sense? So spread of exact the same amount of payment or reception of money every period with the same interval for number of the period.
So it's the same time and the same amount. So
Same intervals, same amount for determined number of the years. Meaning that years now also need to be determined. If it's not determined, it's called different name. What is that name? If your annuity never has an end to it, it's called perpetuity. And why it's important to know these? Because you're going to have them all. You're going to have annuity, you're going to have perpetuity in your life. So what would be a good example of your annuity? What is that? What kind of endeavor you're going to be involved with that is going to be you're going to be using annuity? Income? No, your income fluctuates.
Bonds? Bonds?
Fluctuates.
mortgages. car
Thank
loans.
you. When you buy, either you're going to buy a house or you're going to rent an apartment. Both of them are annuity. Meaning what? Aren't you, if you buy a house, don't you pay the exact same amount every period for duration of that loan? 15 years, 30 years? That's annuity. That's a good example of annuity. However, what would be a good example of perpetuity? That doesn't have any end, unless your life ends, God forbid.
Savings account?
Huh?
Savings account?
Savings account also, everything changes. Folks,
Life insurance.
life insurance could be one, but the most common one if you have your pension plan, if you're in pension, or your Social Security. When you retire, you're going to get your Social Security exactly same amount, same periods, but as long as you're alive. And there's no end to it. Like I said, the end is your life. What an example, actually in pension plan, that even goes further than you're dead. Meaning that if you have a certain term with your pension plan, you retire, you get it till as long as you're alive. But also you could name beneficiary after you're dead, your beneficiary also could get that. So there's no end for it. There is an end for it, but not in your life at the time. That's called perpetuity. Here it says annuity, ordinary annuity. There's what? Is there any type of annuity also? Yeah, there's another one called annuity due. That's what Josh referred to. Ordinary annuity is when the payments happens at the end of the period. For instance, your mortgage. Your mortgage, you don't pay the mortgage before moving to your house. You live in your house for a month, and after that what? You pay your mortgage. So the payments happen at the end of the period. Can anybody tell me what is annuity due, meaning that all the payments happen at the beginning of the period? What that would be? Any example of that?
Rent.
Huh? Rent, yeah. You want to move to your apartment, you got to pay the rent first. That's called annuity due. What's the difference between these two? Annuity due has one extra period of payment, which is more than ordinary annuity. Okay?
That was called annuity due.
Yes, D-U-E. However, in real life, most of investments that we have has uneven cash flow stream, meaning that they are not annuity. Many things that we do in life, many investment making up, meaning that when you buy stock, when you buy a company, you buy anything, your cash flow or expected cash flow from that investment is uneven. Some years you get more, some years you get less, some years you don't get anything, some years you get, you lose. So here is again, when you want to put the timelines of uneven cash flow, this is how it's going to look like. But guess what? Year 0 is always what? Minus. That's your original what? Investments, that's your cash outflow. The other ones are positive. Those are your cash inflows. Okay. What is the future value of initial $100 after 3 years if the interest rate is 10%? That's what I put on the door. Okay. But we're going to take a look at it in different under different light. We're going to say, hey, let's draw the timeline for it. Okay, what's the timeline? $100. We want for 3 years, 10%. What is the FD or future value of that? Okay. So there are 3 steps, step by step. We did that. You already saw that. Okay, I put it on the board. I put also the formula on the board. But we're going to use our calculator now. Okay, grab your calculators. So this is how we're going to calculate it with our calculators. Now, first and most important thing about your calculator is that it's like mini computer. Memorizes the previous calculation and adds up to your what? The next calculation. So by turning on and off, it's not going to erase those. You follow? How we're going to erase those previous calculations? We're going to reset our calculator every time we do the calculation. Okay? How we're going to reset it? And I'm hoping that everybody has this model, right? Okay. Find the second key, which is a different color normally. Okay? Push the second button. Go down and find plus and minus button, which says on top of the reset. Push that. Okay? and then go up and push the enter button. Okay, what your calculator is telling you? I want to see what you're seeing on your calculator. Everybody, what do you got in there? What does it say?
RST 000.
RST, meaning that it's already reset, it's a 0. Everybody has that? Perfect. So you reset your calculator.
But you hit second and then clear work down at the bottom?
No, second, reset on the bottom. You see that minus and plus is also reset. Let me see your calculator.
You reset and then enter.
Let me see this. Yeah, you got the right model. Second, reset, plus and minus button, enter. Okay? Now, let's do this. The question is, the problem is, we have $100 and we want to invest it in anything or any investment that is for 3 years, and interest rate is 10%. We want to know the future value of it. We already calculated it earlier. You saw that 133. Now your calculator is going to do that. Let me tell you one very important fact about your calculator, financial calculator, or your Excel. Folks, none of these solves the problem for you. You solve the problem. The Excel or calculator only calculates faster. That's all it does. If instead of 3 years I would have given you 30 years, you would have been standing here for half an hour to calculate that. But calculator does it in about half a second. That's the only difference. So here, example was, hey, how much your money is going to worth, $100 money that you have, how much is going to worth 3 years from now if the interest rate on it is 10%? That's the question. Now you're going to tell calculator, hey, calculate this for me fast. Okay. So there is no particular order on this, but you're going to enter all these entries. So first, let's go with N. You're going to push 3. Well, what is the number of years? 3, right? Push 3 button in your calculator. You go and find N on top. Actually, that's the third row from the top. Push N. What do you see in your calculator?
N equals 3.0.
Everybody sees that, right? Next, interest rate. Enter 10 in your calculator and push I over Y, which is next to N. So your calculator should say I over Y equals 10, right? Next, present value of your money. You're going to enter 100, but you're going to make it negative. So push plus and minus button. Everybody did that? And push PV on your calculator, which is next to I over Y. So your calculator should say PV equals to minus what? My 100, right?
So you do the negative after the digits, not before, right? I think I did. You entered the negative after you entered 100. Right?
That's exactly right. After you enter 100, then you make it either positive or negative. Thank you. Okay, now, next, PMT stands for payment. Why we have this in there? Because some of our calculation requires us to enter the payment, like annuity. Hey, what's my payment? Or perpetuity. Or how much is my payment every month, every year. Because of that, calculator is have a built-in payment option here. However, in present value, future value, the way that we talked about, we don't have any payment. So you're going to enter 0 and go up there and push PMT button. So your calculator should say PMT is equal 0, right? Okay. What do we want to calculate? Future value. So you're going to go on very top of your calculator, the left hand side on very top, it says CPT. CPT stands for capture, meaning that calculate. We're going to push that, push, and go and find a fee button. which is next to payment. Push that. What do you got?
That number?
133.1.
Everybody? Okay, simple as that. That's our beginning. Now you see how simple it could be? Believe me, even you good at, if you're good at Excel, it's not as fast as calculating. That's my experience. Here's your formula in Excel. If any of you are using Excel, just go to formula FV, enter the rate, which is 10%, enter the number of the period, which is 3, enter the payment, which is 0, enter the present value, which is minus 100, and the type normally always your type 0 in here, except for this annuity do it, which is 1. But put into 0, boom, you got the answer. But this is much faster. Are we okay? Yeah? Any questions? All right. Now, that was future value, right? We calculated the future value of $100 in become over $133 with 10%. Now, this time, let's calculate present value, not future value, present value of $100 3 years from now with 10%. Go ahead and do it. You know how to do it now. You want me to display the other one like this for you for now? Yeah, okay, I'm gonna display this for now for you to see it till you become comfortable. Then I'm not gonna show this to you. You're gonna just calculate it yourself. All right, this is your present value. Go ahead and enter those numbers, see if you come up with minus 75.13. You all got it? Yeah?
Yeah.
Good to go? All right, wonderful. All right, so do this. This time the unknown is what? Interest rate. So we have been given the present value and the future value and number of the years in our investment asking for interest rate, I over Y. Bear in mind, the only thing that is you have to pay attention here is that either your future value or your present value should be what? Negative. Why? Because you cannot say, hey, I invested $100 million and it was not out of my pocket, somebody, I earned that, and again, I'm gonna be earning future money. That doesn't make sense. You have to spend money to get money. Meaning that you have to spend it coming out of your pocket first, and then you're gonna get money back. You follow? So you cannot enter both of them positive or both of them negative. Because in real life, it doesn't make sense. If you wanna buy something and buying the stocks, expecting a rate of return on the stock, well, when you buy it, you pay for it. And then you receive cash flow from it. So, in here, your present value always is what? Minus, right? Your future value would be positive. Okay, calculate it, please. What do you got?
Alright.
Oh, I thought you already done.
I was wondering the negative thing.
Yeah.
Would it be 8%? would be 8%?
I think so. We'll take a look at it now, but it sounds good, it sounds right. Now, this is a good opportunity for me to tell you that the way that you're going to be answering this in your final or midterm exam is that, let me write it for you, is that let's suppose this is one of the problems that you're going to have in your midterm. Now, obviously, you're going to use your calculator, financial calculator, or perhaps your Excel. So the moment you do that, let's say in this example, we're going to come up with the number 8. So your midterm, let's suppose, I gave you multiple choice, okay, which one of them, 8, 10, 12, 13, whatever. And you're going to circle 8, that's my answer. But I expect you to do something else also. What is that? Because I don't want you to just circle the number and say this is the answer. I want you to show me the calculation. So you're going to say, hey, what kind of calculation you want? This is financial calculator and told me 8. I want this. Look. We say present value of any investment is the future value of it divided by 1 plus I, number of n, right? So what is given to us here? What is given to us, present value is how much? Minus 100, right? What's the future value? 125.9, was it 97? Yeah. 1 plus I is power of 3. Actually, you're calculating that. Your financial calculator calculated that for you. You follow? But your solution is not calculated. Your solution is this formula. Oh yeah, well, I is unknown here. But I don't want you to struggle to come up with the I here because it's going to take some time for you. But when you enter it in calculator, it immediately give you answer to you. It's 8, okay? So now you're going to say, I'm going to circle A, B, C, D, and 8 is C. So I'm going to say this. Okay, we got it. But if you don't show me this, circle the 8, you haven't done the job yet. And bear in mind, what's the benefit of it? Trust me. If I see this, but I see here 7.9, because of rounding or whatever, you're still going to earn the credit for it. Mean that, hey, you know what you're doing. But for whatever reason, rounding up or whatever, you didn't come exact number, it's okay. Okay? Yes, sir.
Do you want us to do all the algebraic rearranging, or don't do any of that, right? Where like you would multiply both sides?
No. This is not math class.
Okay.
If you'd like to do it, I'd love to see it. But no, you don't have to. You just show me, hey, another word I'm saying is this, very simply. Let's suppose we didn't have financial calculator, we didn't have Excel in our lives. If I gave you that problem, what kind of formula are you using? Oh, I use this, but I'm gonna spend half an hour calculating that. Yeah, okay, well, don't. Because financial calculator is gonna do it for you. That's what I wanna see. Okay, for some of you using Excel, these material are available to you in your resource, Blackboard. All my PowerPoints are there. So in case if you wanna just do this through your Excel, those are the formulas for you. Okay, this is a tricky one, but I want to challenge you. If sales grow at 20% every year, how long before your sales doubles? Anybody come up with the answer?
I don't know if it's right, but I came up with 3.8 years.
I think so. Right. Here, folks, you have to make certain assumptions. Whatever the number you choose, either one is going to be 2, or 10 is going to be 20, or 50 is going to be 100. Right? So that's your assumption. The rest is piece of cake.
Wait, what exactly did you do? Because I use logarithms.
What's that?
I solved it with a logarithm, so I was wondering what he did.
No. Basically, you take a number,
Yeah.
whatever number you take, and then multiply that by 2. Aren't we saying your sales is double? Well, what is my sale? Whatever the number is. Multiply by 2, and that'll be your future. So 1 versus what? 2. So enter whatever, -1, the other one what? +2. That's what you did, right?
I did -1 as the present value,
Yeah.
and then I just did 2
Yeah.
as the future value times it by
Exactly.
2.
Exactly.
Yeah.
And that's the assumption you make. Doesn't matter what number is. Whatever the number is, make that twice as much in the future and give you the same number. Because here, the all the purpose is that to do whatever you will have as an investment doubles. You got it? Everybody? What is it?
I 3.8 also.
Okay. That was much simpler than what you assumed. Okay, so here it is. Again, enter in the financial calculator. These are your entries. Interest rate 20, payment 0, and whatever number you enter for present value, it should be minus, and future value twice as much what you enter for present value. If you enter in here minus 100, future value should be plus 200. So N is 3.8. Again, for Excel, that's your formula. Now, I talked about this, but just basically graphically showing you what's the difference between ordinary annuity versus annuity due. You see the payments, only difference is that payments in ordinary annuity are at the end of the period. For annuity due, it is so let's solve this. I think we did that. No, let's do it. Okay, so we're saying that we have 3-year annuity, ordinary annuity of $100 at 10%. Now, you see that there's a certain calculation here that we didn't do. So let's suppose, let me explain this. Here we're saying that you are going to be getting $100 every year. And what is the value of this total thing that we're going to give you with $100 every year with 10% interest? Now, if we didn't have 10% interest, the answer is very simple. Hey, we're going to give you $100 every year. How much you're going to have at the end of 3 years? Well, I'm going to have 100. But I'm saying, hey, also there's 10% involved in this. Calculate the value of it after 3 years. That's your annuity. Let's see if you could come up with this one. Now, in annuity due, all you need to do is add 1 period to it. So, meaning that he is in himself thrilled before. Okay? Everybody come up with 331? Yeah? Okay, good. Now these are, let me see. Okay, how about this? Let's do this. Okay, we did that. Okay. How about we have $100 you receive as payment, and we want to know, now remember this is the opposite of it. I'm saying, hey, I'm going to give you $100 every month. I'm sorry, every year here, I guess. I'm going to give you $100 every year for next 3 years. What's the present value of this money? You know, the future value of it with 10%, you came up with the $331, right? So I'm saying, hey, what's the present value of this money? And your calculation is going to be different. On the first calculation, what was your present value? Look at it. This is the difference. In the first calculation, your present value was 0. Meaning that I'm not saying how much you have. I'm saying I'm going to give you $100 for next 3 years with 10% interest. What are you going to have at the end of the 3 years? What's the present value of it? Well, you don't have any money yet. You're going to be receiving it. You follow? On the second calculation, your future value is 0. Why? Because I'm saying if I give you $100 for 3 years, what's the present value of that? So you calculate present value. So you have to make 0 for present value on calculating the future, or calculating the present value, make the future value 0. calculating the future value and make what? Present value 0. So one of them has to be 0 for you to get the answer. So let's do this. Let's see if you come up with the minus 248.69.
So how could you have something with no future value?
Now, here, the assumption is that what is the value of $100 every year at, if I decide to give you $100. I'm going to give you $100 next year. I'm going to give you $100 following year, and $100 following year for 3 years. What is the value of it today? Because we're not focusing on what is the future value, because you already calculated earlier. But here the question is, look, another one, what I'm going to say, the easiest way of saying it is this. Hey, you want $300 3 years from now, or $250 today? You see what I'm getting at? That's what we calculated. So here, if you say, hey, give me $248.69 right now, there is no future value for it. You follow?
Okay. Yeah, it also.
How much? Yeah, how much would accept then today that you're not going to demand anything 3 years from now?
Yeah.
That's another way of saying it.
And you don't, actually, it works if you don't enter anything for future value at all.
Yeah. Yeah. Okay. Calculate this. First, let's calculate this. I'm saying what is the present value of 5-year, $100 ordinary annuity at 10%. First, calculate that, please. 5-year, $100 ordinary annuity at 10%. We want to find the present value of it. Okay, so you come up with 379.08, right? Okay, now do this. Do the same calculation, this time for 10-year, and next time for 25-year, and third time for perpetuity. Of course, I'm going to show the perpetuity is very simple. But do it for 10 years and 25 years. Okay, what is it for 10 years?
614.46.
And for 25 years?
907.70.
Everybody come up with those numbers, or you're working on it yet? Okay, I'll give you a few more seconds.
Professor, would the face value just be calculated as just like a normal like calculation? Like, would you just take like 10 years times the $100 times 1.1, including for the interest rate, to give you just the face value? That's what most people are familiar with.
Actually, that's how you people think normally.
Yeah. And then is that like, for example, for like 10 years, that would be, I think, about $1,100? And then,
Something like that, yeah.
And then would you compare it against that 614, or you wouldn't want to do that?
No, but see, this is basically the concept. Look, somebody says, hey, look, I'm going to give you $100 for the next 10 years. Okay? You're going to collect $100 from me for the next 10 years. Would you like to settle this today? I mean, how much you willing to accept today instead of collecting $100 for the next 10 years? In other words, for $1,000, I'm going to give you $100 a year. How much you settling this to receive today in lump sum?
I see, yeah.
Oh, yeah, well, let me calculate. I'll accept $614 today, and I'll forego to collect $100 every year for the next 10 years. Isn't that how lottery normally operates? And what's the difference between lump sum versus the payment? That's the calculation they make. So in other words, you go to a lottery, let's say you won 25 million. They say, hey, we could pay you 25 million for the next 20 years, and this is your payment every year. Or would you like to have lump sum? If you say yes, guess how much that's going to be? If 25 million, you're going to get maybe 8 million. And of course, 8 million is also tax included. So if you take the tax away, it probably will be like 15 million or 16 million or something like that. Big difference. You know what I'm getting at? That's the calculation. But guess what? Even this is even more important when you said, Josh, for 25 years, you're going to be receiving $100 a year. Unless you want a lump sum. You know, say, wait a second, 25 years, that'd be like $100 a year. So we talk about $2,500. How much are we going to need to settle this with? Guess what? It's only $907.
I see.
Yeah. So you better understand. We better understand that. Now, what is the future value of our in ordinary, meaning that when the payments are involved, how much the value of it right now? What we were going to be receiving in payments, which are, like we said, that in annuity is a certain amount, fixed amount for number of the periods that are in the same interval. So many things in life are like this. Like I gave you the example of lottery. In some of the cases, many of the prizes that they advertise or give you, or in let's say game shows in TV, for instance, you won $1 million. That $1 million is not that you're going to write them a check next day. It is payments for the next 20 years. And the guy say, okay, what's my, if I'm going to take a lump sum, okay, here's your $150. See you later. Not 100. If it's $1 million, probably they give you what, $300,000 or something like that. So, how they calculate it? Like this. Perpetuity. Okay. Like we said, that perpetuity basically is your annuity never ends. So formula of it is very simple. Your present value of this particular perpetuity, which is what? Payments, divided by interest gives you the present value of your perpetuity. So obvious payment was 100, interest rate 10%. Present value of this perpetuity is only 1,000. Now, why this is important? Let me give you an example. Actually, I calculated my own pension plan before I withdraw my money from my pension. I called and asked the pension fund company that was the financial institution that was holding my pension plan. I said that if I retire at this age, how much I have lump sum in my pot, if you will. And they give me a number. But it's there, when they see it, there's nothing mystery here. Okay, if I retire, what would be my payment every year or every month? You know, either one, it doesn't matter. Oh, you're going to be receiving this much. I want to find out what kind of interest involved in my pension plan, and based on what interest they're paying me. That was important to me to know. You follow? So what I did, I took that, whatever lump sum was in the pot, put it in here, and they told me you're going to be receiving this much every year. I put it in here and come up with the I. And you know what it is? What was I? 10%. They're calculating 10%. They make him, or they pay me based on 10% interest. And then you may wonder, why they give you 10%? They could have given you 5% or 3%. Yeah, but higher is better for them. Because I'm not going to see that money, that's their money. Now, you know, you're not going to give me my pension plan back to me. They're paying on the interest on it to me. So higher interest, higher I'm going to be receiving. That money is yours, theirs, mine. It's not mine anymore. So anyways, that's some of the usage of it. Or you could calculate it any other way. Hey, they tell you have this much in pot, and interest involved with this particular pension plan is 10%, 8%, whatever. You're going to find out how much you're going to be receiving every month, every year. You could calculate ahead of time and decide, hey, should I retire now or retire 5 years from now? Is this enough to meet my needs? Whatever the question. But those are the usage. Sometimes it's important for us to know. Okay. Here we go. You're going to be calculating this. A 20-year-old student wants to save $3 a day for her retirement. So imagine that. Let's say you just put $3 aside in your drawer. And she places the $300 in the drawer. At the end of the year, she invests this accumulated saving, because if you multiply this $3 with 365, which is the number in a year, you're going to come out how much you accumulated in your drawer, right? Annually, which is going to be $1,095. So she is going to have $1,095 in her drawer at the end of the year. Follow? Now she takes this to a brokerage firm and opens an account that pays her 12%. Now you may say, well, that's not realistic. 12% is too high. No, it's not. In certain accounts, when you don't touch your money for this or less the next 40 years, 30 years, whatever, they pay you higher interest. And you're going to see why. So how much she's going to have when she retires at age of 65 years old? Would you calculate that? By the way, this $1,095 is payment for every year, meaning that every year she's depositing that for the next 45 years. come up with it? How much is it?
1,487,261.89.
Isn't that amazing? You put $3 aside, when you retire, you're gonna have $1,480,000. That's power of compounding. Now, this also answers the question if you say, wait a second, why you collect money from your pension or social security for the rest of your life, and they're giving you all this money? Well, because your money grew to be that much. You see how, just imagine instead of $3, how much federal government collects in daily basis from people. So what's a compound on that when they want to give them social security after 45 years, 40 years, 30 years, 35 years, whatever. They have trillions and trillions of dollars. Well, obviously, they don't invest it the way that we have. This girl is investing in brokerage firm, but that's the value of it. That's what I'm getting at. Okay, now, everybody come up with 1,480,000? Okay, good. Now, next step is, let's see, okay, we got that. And this is how you do it, obviously. And now next, let's suppose if you don't start saving until you're 40, and you're lost and say, hey, you know what? I could start saving from this point on for my retirement. And let's see how much this individual is going to get when he or she gets to age of 65, meaning that now duration of the investment is not it's only what, 25 years instead of 45 years. See how much that is going to be, lump sum. How much?
146,000.
15.
What?
Yeah.
146, right?
146,059.
What's the difference between this and the previous one?
10 years of compounding.
Yeah, but how much was that girl's 148,
yeah.
1,480,
Right.
which is what, 100 and something?
Yeah.
So difference of what, 1.3 million?
Yeah.
You see how different, how amazingly there is a gap between the girl that started for 20 years versus you start 40 years. Basically, that girl started at 20 years is going to have $1.3 million more than the individual who started at 40 years. That's how important it is for you especially to start what? Saving or investing at this age rather than 40 or 50. And that's one of the reasons, by the way, that insurance companies, well, when you have a life insurance, let's suppose, early ages you have, much more money you're going to get when you pass away and whatnot. Not you're going to get your beneficiaries or whoever. Or you want to basically retire your life insurance. You could withdraw it anytime you want, if you choose. But of course, they give you less than what it's worth, by the way, but you get it. So my point is that you see, like people like me, absolutely doesn't make sense to me to buy a life insurance. And you understand as to, you know, why? What am I going to get? Basically nothing. But if you start at 20 years, you got a major investment in there. So, that basically verifies the fact. Okay. So, let's suppose that you're that 40 years old individual. And you say, you know what, it's $148,000 is not going to be enough. I wanna have that 1,480,000, because that's what I'm gonna be happy to retire. Calculate how much this individual has to put aside annually to receive $1,480,000 at the end of his retirement. I'm gonna display the numbers one more time for you, that you have everything you need. How much, Charles?
$11,154.42.
How much a day?
Oh, a day?
Yeah, oh, and they both are what I'm getting at, not that calculate how much a day. Because that girl was putting, what, $3 aside? Let's see how much this, how much?
$30.
Yeah, 10 times as much. And it's not a bad deal. I mean, for people who are very, they have good income in 40 years old, yeah, put $30 a day aside. That should not be bothered, should not make big difference in your life. But guess what? You're increasing chance of your investment from 143,000 to 1,480,000, which is a big difference. Everybody come up with $30 a day? Yeah? Yeah, 11,154. Translate to just about $30 a day. Okay. Now, so far what we have been calculating, the annuity due, the payments or the cash cash flows that are same amount for number of the periods, so far and so on. But in reality, many of the investments that we make do have what? Uneven cash flows. Meaning that if you are buying a company, this company is going to be yielding you different incomes every year, different cash flows every year. For instance, in this particular scenario, it says, hey, this particular investment that you're having with 10% discount rate is going to give you $100 million. First year, 300 million. Second year, 300 million. Third year, and you're going to lose 50 million at fourth year. So, how we calculate the present value of this? Remember, I talked about this earlier. All you need to do is that calculate present value of your future what? Cash flow. So what's your future cash flow after 1 year? 100 million. Okay, with 10%, discount this with 10% to present, it'll be 90.91. Do the same thing for second year. Well, how much is second year? 300 million. What 10% discount 2 years from now is 247.93. Your 300 million 3 years from now with 10% is 225.39. And your minus 50 4 years from now with 10% discount is going to be 34.15. when you add these all together, you're gonna know the present value of this investment. Now, how we're gonna use financial calculator for this is gonna be totally different. So I'm gonna teach you how to do it. Let's do the calculation for this to come up with the present value of these stream of incomes or cash flows. Now, again, reset your calculator. Okay, ready? Here, the first thing you do for uneven cash flow, find the button that says CF, which is next to your second button. You see that? Push that button. And when I ask you what you see in your calculator, you better please answer me, because I don't know what you see in your calculator. I know everybody's in the same page. So what do you see in your calculator?
CFO equals 0.
Everybody?
Yes.
Good. How much is your CF0 here?
Zero.
Huh? 0. So enter 0. Push enter button in your calculator on top. Your calculator should say CF0 is equals 0, right? Okay. Go and find a sign that is arrow down in the same row. You saw that? Push that. What do you see?
CO1.
CO1 equals to 0. Asking you what is your cash inflow on the first year. How much is it? 100. Enter 100 and push enter button. Your calculator should say CO1 is equal 100, right? Okay. Go and find the arrow down button again. What does it say?
FO1.
FO1. F means frequency of this number. What is frequency of the number? Somebody says, well, I'm going to be cash flow of $100 a year for next 100 years. Well, you're not going to do this 100 times in a year. Just put 100 times, frequency 100. It will automatically give you the answer. Follow? However, in this frequency only twice, and you don't want to even bother with that. So frequency, you just ignore it. So arrow down one more time. Now asking you for CO2. What is it? 300. Push 300, push enter. So it should say CO2 is equal what? 300. Okay, again arrow down. Frequency of second one. You don't want to enter that. Arrow down one more time. CO3 is equal to 0. Everybody has that right? Okay, what is it? 300. Enter. Push button, enter. Arrow down. Frequency of 3. Arrow down one more time. CO4. What is CO4? Minus 50. So enter 50 and then push plus and minus button. CO4 is what? Minus 50. Enter. CO4 is equal minus 50. So far so good? Everybody's in that screen? All right. Arrow down one more time. Frequency of 4. Hey, we're done. We don't have any. Okay, good. What do you want to find out here? We want to find out the present value of this particular investment. Net present value is the same as present value in uneven cash flow. So push net NPV. What your calculator is asking you. What is your I? Interest rate. What is the interest rate here? I think it was 10%, wasn't it? Yeah, I think. Let me check it out, make sure. Yeah, 10% right there. Okay? So, enter 10. Push enter button again. Okay? So what your calculator is showing you? Tell me.
I equals 10.
Everybody, I is equal to 10. Okay?
Sorry, after you get down from the frequency, how do you get back over into this?
Arrow up.
Oh, use arrow up,
Mhm.
and then
Up
from
and
there-
down, yeah.
Oh, and then to put in like, do you want to put 4 for the N or anything for 4 years? Or-
4 years.
Or for the interest rate, do you want to put in, like, what would you do from
Okay,
here?
okay, look, when you go to, minus 50, go arrow down, okay?
Yeah.
So I said that in this case, we're done. So push NPV button, okay? Now put in 10 in there. Enter. Okay? Now arrow down. Okay? Now arrow down on the I. Don't, we're there, we're not there yet. So arrow down on this I over equals to 10. What do you see in your calculator? NPV. This is asking you, do I need to calculate NPV? You're going to say yes. Yes means capture, CPT on the top. How much is it?
530.09?
Let me see if it, 530? Yeah? Okay, that's your answer. Didn't we come up with it earlier? Here we go. 530.08. Okay? Any questions on this?
So does this just round to the nearest penny?
Yeah, don't worry about those. Yeah, your calculator rounds it up by itself. And here, if you put your calculator in more than 2 digits, let's say 4-digit decimal,
Yeah.
then it gives you exactly 899 whatever. That calculates the 8.9 just because it already rounds off for you. All right, are we good shape now? Any questions? So we're going to do more of these calculations going forward. I'm going to ask you, like in I don't know, a couple of weeks from now, to do certain investments. You're going to do these while you're calculating. Okay? I think you deserve a break, don't you think so?
Yeah.
Yeah, take 15.